Hi everyone, I hope you're all healthy and well. Apologies I can't be there this evening. I'm currently up in Queensland with the family. By the time you're watching this, I'm sure I'll be sitting by the pool drinking a cocktail. No, let's be fair, I'm going to be trying to get two kids to bed, but at least I'll be on holiday in Queensland. So, a very much an enjoyable trip and looking forward to it. So, I wanted to put this video together just to provide some insight and a little bit of a summary around the portfolio, also what we're seeing in markets as well. Now, I know these can go on for a long time, so I'll try my best to keep it short tonight. I know you guys have a lot to get through. Now, the first thing I wanted to tackle is the US election. Again, by the time you're watching this, it's probably all well underway. So I can't say what's happening, but I can definitely give you my thoughts for the moment. For a period of time there, it was looking like Trump was going to walk away with it. But on the back of his debate with Biden, on the back of his dealings with COVID, he's definitely lost a lot of traction. So at the moment, Biden's actually looking like he's going to be the standout to walk away with it. But again, by the time you're watching this, that could be completely wrong. Because what happens in the US is there's no mandatory requirement to vote. So it all depends on who shows up on the day. Nevertheless, there will be a change in some way, shape, or form. And what will be the impact to the market? Now, originally, when we were going into COVID at the start of it, there was a big concern that there was going to be a drop off come the US election. But what we have seen through the last sort of 6 to 9 months has been a huge amount of government stimulus, and that's both in Australia and globally as well. And what that means is there's a lot of money floating around in the system, and that has to have somewhere to go. And where we're seeing it go is into markets. So thanks to globally interest rates being at record lows, and within Australia there's actually talk that next week, so the first RBA meeting in November, of them actually cutting rates again down to about 0.1. So what this means is that people aren't going to be putting money into cash and fixed interest because the returns just aren't there. They're putting it into the markets instead, and they're putting it into stocks that they know the dividends or the income is going to be better than what they get in the bank. So that is what's keeping the markets artificially propped up or strong. So we think with that volume of cash floating around that the market should stay fairly stable for a period of time. Around that in Australia, COVID, and I guess globally as well, COVID is the biggest talking point and has been for the last 9 months. We're seeing Victoria start to open up. New South Wales is opening up. WA would be happy if it broke away from the country and floated away. They're still completely locked down from the rest of the world. But we're seeing Northern Territory, we're seeing Queensland, we're seeing South Australia opening back up and people starting to move between the states. So we are coming out of it now, which is great. We had the budget recently, and there was a huge push on infrastructure spend because that's a great way of getting money back into the system and getting jobs up and going, getting projects up and going. So a lot of positivity on the back of the recent budget. So COVID is still an issue without question of a doubt, but in Australia, I think we really have got away pretty much scot-free compared to, let's look at Italy, France, and obviously big parts of America as well. We're seeing second waves come through and still seeing some pretty high numbers. But time will tell what happens with things like vaccines or just in general about stopping breakouts from happening again. So it's been certainly a year where the handbrake has been put on for various reasons, a year we definitely won't forget, and 2021 will certainly still have a lot of hurdles. There's a lot of people that really have this hope that on midnight on New Year's Eve that 2021 will come around and it'll be completely like the old days, like 2019. It's not going to be the case. We still have a lot to get through economically. We still have a lot to get through on the health front. So it's still going to be a difficult year. But obviously, from what we can see so far, a lot more positive. So let's have a look at the portfolio. And then hopefully you'll have a copy of that in front of you on the night. The one that I'm running off of will be a little different. It'll be a few days older than the one you've got in your hands, but the concepts and themes are still exactly the same. So going through the portfolio, what we look at is, again, that asset allocation piece being the biggest driver of performance. We know that the goal was that it was going to remain a pretty defensive portfolio for reasons we've obviously been discussing in the past. And at the moment, about 42% of the portfolio is in fixed interest, which means about 58% of it is in your growth assets. And around 24% of that is in Australian shares. So we have a look at the Australian shares, for example, and one of the new inclusions we made into the portfolio was Bingo. That has continued to do really well. We've made around 20% profit on that so far, which is great. I'm still happy to retain holding that. We still like that moving forward, so we'll continue to hold that in the portfolio. We have exposure through diversified means through those ETFs and through managed funds into our international. And obviously DNR is the bulk of our Aussie exposure. So what DNR has been doing over the period of COVID has been doing a fair bit of change, a lot of buying, because obviously it was a depressed market, and what that's enabled them to do is to pick up some cheap units. Going into COVID, DNR was struggling a little bit, but as was every other SMA on the market, DNR still outperformed all other SMAs. What the biggest hurdle for people running an SMA were looking at the wider market. Some of the stocks like your Afterpay, like CSL, were just so highly valued, it just didn't make sense to buy them, but they continue to run. And those stocks that continue to run were a big driver on Aussie market performance. But not many people held them because they were so expensive to buy. To buy CSL at $300 just didn't make sense. To buy Afterpay at $80, $90 just didn't make sense. So it's been certainly a year where we've had some very big performers, and we've also had a year where everyone has sort of just chugged along. Now, with the DNR portfolio, it's now really starting to turn around. We've had some good returns of market outperformance over the last sort of 6 months because, like I said, they've done a lot of buying, picked up some cheap units, and we're seeing that now flow through to the portfolio as I guess generally most stocks are starting to come out of that COVID lull. So we're seeing some good numbers there. Macquarie Income Opportunities Fund, I'm bouncing around a bit as I'm going to investments that stand out to me. Macquarie Income Opportunities Fund, so now this is one of our fixed interest exposures. We've liked it in the past, it's been ultra defensive, and during a time like COVID, it's where it really proved its value. So Macquarie Income, what it does is it digs its heels in, it pays a low yield, but it's very, very defensive in a time like COVID, which was super beneficial. So you don't see that volatility, it just holds its asset value and largely just sits still. But now as markets are recovering, we're seeing people start to move out of it and they're seeking either better yield or getting into growth investments. So what I will recommend, and we'll put this all in an email for everyone, is we'll get everybody out of Macquarie Income Opportunities and put you into some listed fixed interest. So staying within the fixed interest or within the high yielding, in the yielding space, so not into growth investments, so not into Aussie or international. We want to keep it into the fixed interest space, but we're just going to go into something that is a little better income generating than what the Macquarie Fund is. It might come with a little bit more volatility, but we'll take that little bit of volatility over the opportunity to get a better yield. So we'll put those recommendations to you all in an email. For a new inclusion to the portfolio, something that we've been watching for a little while, we wanted to see some good performance and it's starting to track up nicely, is Sydney Airports. Now this is going to be a longer story, again 2021. I may have broached it with you in the past. I'd like to again put it forward that we put it into the portfolio, and Sydney Airports is something that as travel is beginning to take off, we are seeing the states starting to connect again. Sydney, Melbourne are going to be the linchpins. They're obviously the biggest hubs. I know I'm flying from Adelaide to Sydney, Sydney to Brisbane. So a lot of the flights are now being directed through Sydney airports. So what we're seeing is that foot traffic start to pick up. So with Sydney airports, again, as those gates open, as people start flying around a lot more, then we're going to see a big uplift there in going back to a sense of normality for the airport. At its peak, foot traffic was down to 98%, 98% off of its peak. So we're talking 2% of its daily foot traffic was all that was going through. Those numbers are absolutely coming back up now, and we're seeing that in the share price. So we'll put that in the email for you as well, around the inclusion of Sydney Airport. From a performance perspective, I think it really speaks to the asset allocation piece. It's been defensive. So for us over the last 12 months, it's done -3%. It sounds terrible, but over the last 12 months, the Aussie market has done -8.5%. So by having that defensive element, we have certainly softened the impact of that. International has done really well. International over that last 12 months has been a positive territory. But what we're trying to work out now, and we're trying to get some external people to help on this, is to get a better feel for when you strip out the likes of Amazon, Netflix, Google, Apple, Facebook, how has a global index actually performed? Because those tech stocks have been such big contributing factors to performance, it's sort of almost an artificial performance figure. So international has done well, but it's been really heavily pushed and guided by those tech stocks. So we're trying to work out what the world looks like minus those anomalies. So again, for us, it's done well. It's softened the blow by having that fixed interest exposure, which was exactly what we set out from day one, was to create a portfolio that wasn't as highly volatile as something that might be way more focused on growth. Now the objective is to get some better yield by changing the Macquarie fund, and also the inclusion of Sydney for a little bit more growth. As always, if there's any questions, please do just either ring me or send me an email. We'll put these recommendations to you in email as well, and get that across. Again, I hope everybody's well, and I look forward to see you all in person next time. Thanks, everyone.